S&P is a little directionless today, kind of drifting down about 20 bips with about a half hour left. Kevin Green, our options guru here, taking a look at the flows for us. Kind of a quiet Friday. That seems like somewhat of a win here for bulls, KG.
Yeah, as long as we can maintain the 5,700 level, I think that would be a win. We have seen a little bit of compression in the market here today, Oliver, even though, we haven't seen a lot of downside moves over the last couple of trading sessions. Today, we actually did get a little bit of a flush and we were able to recover. But if we're looking at the open interest chart, the 5-day, 15-minute, you can see we're kind of flagging out. So we have an overall bull trend that's taking place. And now we're seeing this bull flag scenario where we're kind of maybe cooling off a bit before we try to move higher. We're trying to break above that channel line right now, but when you're talking about quarterly expirations, it's not uncommon for us to actually have some pretty significant pen risk here. When you're looking at the options volume, you're not seeing anything that's too aggressive for a day like today. And in fact, I think we've actually seen a little bit lower volume today than what we would have seen yesterday, what we saw yesterday when it comes to the top contract. So, not a lot to kind of say we could have like a gamma squeeze scenario or a breakdown scenario. That just doesn't seem to be the case. There is some targeting at the 5710 level. It's going to be your upper area of resistance, and then your lower area of resistance right now, really targeting around that 5680-ish area. So not a lot of action for the most part. If you can break what's above 5715, then that's where you can get a squeeze, but we would have to have a significant amount of flows to actually come in within the next 26 minutes in order to do so.
All right, it seems like a fairly balanced positioning going on at this moment, which feels like a healthy thing.
Yeah, I mean, when you're kind of looking at the scenario for this week, I mean, we haven't had anything that was out of the ordinary outside of the outsized moves to the upside. But when you're talking about overall positioning, it has been very balanced. I mean, we've had these institutions continuing to roll up their calls, ultimately bullish. You have them also rolling up those puts for the most part. That's still kind of bullish for now. And when we set aside, when we come into next week, we'll actually have new market structure going into the last quarter of this year, which is going to be very exciting. Now we will have a month-end, expiration to be mindful of. That's going to be consisting of that JPM collar. I'll get those levels next week for that collar position, and then we'll have more passive flows, kind of rebalancing portfolios at the end of calendar September. So maybe a little bit of volatility there, but right now I would say this is a very orderly day. Nothing of a surprise, to say the least. We have a balance level at 5698. There's going to be pen risk at 5,700. So I would not be surprised, and we're not making a call, but I would not be surprised if we kind of stay within that range, so 5695 to 5705.
Okay. So we're fairly well anchored. Seems like we've kind of broken free from the shackles a little bit of that 5,600. So a victory in most regards. Next week, then I guess the challenge is, the question is if we kind of do a stair step, stop and go, or if it gets really melty, and that I suppose depends on whether or not we break through these levels that we're looking at.
Yeah, I would agree. I think we have a lot of Fed speakers next week, too, so that could obviously move the needle. A lot of fresh commentary coming post-meeting, and we actually had a couple of comments coming out today as well. And then we have consumer confidence and then PCE to end the week, which could be bullish if it is going to kind of match the trends that we have seen for some of the other inflationary data. One thing I did want to kind of highlight here is just the kind of quick reaction that we've seen, even though that pullback that we saw in August and early September seemed to be very dramatic. If we kind of look at the percentage of stocks above their 50-day moving average, we're still at fairly elevated levels. And so until we kind of creep above that 80% threshold, which right now we're sitting at around 76%, I think the bulls definitely have it in their favor right now, but you can kind of see what's highlighted in yellow. That's where you kind of get into that overextended zone where we have pretty much a fair amount of stocks trading in bullish uptrends, or at least exceeding that 50%, that 50-day moving average. But we had a nice rapid move to the downside, a really quick recovery on a historic basis. This is a 3-year weekly chart, and hopefully we are able to just continue to grind higher here and not try to have these massive gaps to the upside, as you said, that might not be very sustainable here in the near term. So I would hope that we actually kind of just grind to the upside next week rather than a massive push of say 4.5%, 5%.
It does seem like the moments when we get a lot of companies trading above their 50-day moving averages, obviously those are generally strong moments. both turning points, but also it seems like kind of more once you've hit your groove, the breadth really starts to come in. As we can see, the kind of longer stretches of the rally unperturbed. We got some pretty good moments of participation and breadth. So if things go well, we should, I guess, be expecting that also to continue to expand. It'd be nice to see new breadth highs. That would be pretty huge.
It would, but I mean, once again, if you kind of go to this chart, breadth has been there. We had a brief pullback, but we kind of have a trend line at the bottom there. I mean, the breadth has been there for a very long time. I mean, this is the groove that you are seeing. I mean, if you continue to have positive commentary coming out of the Federal Reserve and good economic data in the labor market that can hold intact here, this is the level that you really want to kind of stay at. I mean, you don't want to get too outsized to the upside where you have 85% of stocks trading at their, 85% of stocks trading above their 50-day. That's when it gets a little bit overextended and we can have pullbacks. Now, this is more of an oscillating type of indicator in the blue rather than a directional indicator. So you have to always keep that in mind, right? But I just wanted people to kind of be mindful here. This melt up that we've had over the last couple of trading sessions is being reflected. This is not something that's very concentrated in one sector or two sectors. This is actually a broad-based rally. And then what we are probably seeing as far as the negatives going to the downside here in the next couple of weeks may be the utilities, maybe the REITs, but they're a very small fraction. I think they're only going to comprise of around 8 to 10% of the total S&P 500 combined. So even that wouldn't be a massive drawdown to the downside when you're looking at that moving average.
Just pulling up again real quick, though. I mean, there were some moments there when we were turning around after brief moments of downside, like first quarter this year, when we came out of a cannon, basically. So when we hit like, 87, 88, percent breadth, I mean, market was like screaming. So that's kind of the distinction I'm making. Like November 23, after we put in that bottom, it was like there were those moments where it looked like we were going to have these frothy kind of everything rallies. So to your point, we did get that yesterday. But those have been kind of flashes in the pan. Like if I stretch it out beyond stocks, like the crypto stuff, we had that yesterday. We've lost some of that a little bit, but that's kind of where I'm thinking, like, do we get one of those moments where it's buy everything, FOMO style? I mean, we're not there quite yet.
I don't think we're there quite yet, and I hope that doesn't actually come back, honestly.
I hear your point on that, too.
That's where it gets a little bit concerning.
Yeah,
because if you kind of look at that, well, yeah, and match that up with the economic data, especially when you're looking at inflation, or even if you're looking at retail sales and spending. I mean, we are still in an environment where inflation, even though people don't want to address it anymore, is still a particular a risk. Bowman actually talked about that today as well. She doesn't want to make it look like the Fed is having a victory lap type of moment here, because we could have that actually spark additional spending and inflation actually reaccelerating here, kind of matching what we did in October of last year. So I kind of, and honestly, Oliver, I know you focus on crypto a lot more. I don't. Crypto is just going to do what it does. I just find it as a very entertaining tool. But when you start looking at stocks that may not deserve rich valuations, like a GameStop or an AMC, starting to catch massive bids, that's where I get a little bit more concerned. That's more of an indicator for me rather than crypto.
True. I put it even further at the end of that spectrum, where it's as far as like connections to true value, et cetera. So to your point, you look at kind of the junkier stocks. That's kind of the idea, is that if people then start splashing around in tokens again, then it's like, all right, we are getting wild. But to your point, that's a kind of a live by the sword, die by the sword thing. That's fun to root for, that type of like buy everything type of momentum. But then that's also, the high beta trade that can cut you the other way. So a kind of a slower, steadier, healthier, rotation driven market with you, 100% healthy. That would be great. Thanks, KG.